Audio Jungle. Audio Jungle. Audio Jungle.
All right. Hello, everyone. Thank you for joining us and welcome to 8th International Young Economics Congress. I'm Cemre Yoldaş from University of Leicester, and I'm going to moderating for this session of the first day of the Congress. And our guest is the Tomy Lee from Central European University. He will discussing his article regulating over-the-counter markets. So, and before our presentation, we accept all questions. Honestly, during the whole presentation time, we accept all questions. But just let you know, we will start asking all questions. Presentation will be done. So, and I will say that thank you for joining us, the Tomy. And so I'm really happy to talk to you again. So your turn. When you start, you can start talking about your article.
Okay, thanks a lot for inviting me. It's an honor to be invited. And I'll be presenting this paper that I recently published with Chaojun Wang, who's at Wharton. So this paper will be about the two different types of markets that people can trade financial assets. So one are the exchanges. So these are things like NASDAQ or Bloomberg, or you can imagine New York Stock Exchange and so on, which are very transparent. You know what prices are available there. Anyone can trade in them, and you don't have to go through any middlemen. You can just send an order to the New York Stock Exchange to try to trade any company, or to NASDAQ to trade Apple stocks, and you know what kind of prices you're going to get, and you don't have to, and you can do so very easily. By contrast, the alternative to exchanges is so-called the over-the-counter markets. So what over-the-counter markets means is that instead of trading on a centralized market like NASDAQ, you instead have to sort of, call random dealers, which are typically very large banks like Citibank, Goldman Sachs, Deutsche Bank, any big bank that you can think of. They're dealers. So here it's not centralized. Instead, you have to go to, say, Goldman Sachs and say, hey, Goldman Sachs, I want to trade Apple stocks. Well, how much Apple stocks do you have? How much can I trade, and at what price? So this over-the-counter market is, of course, very opaque because there's no centralized marketplace with public prices. It's not very accessible because, for instance, myself will not be able to trade over the counter because I don't have a phone number of someone at Citibank and so on. And it is by definition intermediated. You have to trade through these so-called dealers. So the whole market is separated into these two things. Now, you would think that given the opacity and the lack of accessibility of these over-the-counter markets, that the over-the-counter markets would be small compared to exchanges. But this is not the case. So for example, this is the European stocks. And what you see here is that the proportion of trades, so in the bars, on the y-axis and in the bars is the proportion of trades of European stocks that happen on an exchange. And the rest happen on the over-the-counter market. So you see here, across all of these years, since 2018 onwards, and even today, you see that there is not even a trend. Although not even a trend, basically about 80% of trades happen over the counter as opposed to an exchange. And this is despite that, especially because these over-the-counter markets are so opaque, so you don't really know what's going on there. The regulators have been trying very hard to try to push everything onto exchanges, and yet this hasn't worked out. And the main reason it hasn't worked out is because it seems that for whatever reason, these over-the-counter markets going to trade directly with Goldman Sachs as opposed to trading in an exchange like NASDAQ seems to get better prices. So you get better prices, lower trading costs if you trade in these over-the-counter markets. So the goal of this paper is to take a stand on why is it that these over-the-counter markets are so resilient, why so much trades happen in the over-the-counter markets. So first, we're going to take a stand on that. We're going to have a particular story why that happens, and then building a model, building a theory on the stand that we're going to take. We're going to build that theory on top of it and use this theory to consider whether it makes sense, whether it's a good thing for the regulators to try to push trades into exchanges. Okay, so it's so that's where we're going. So specifically, what is a stand that we're going to be taking? So why do we think that the over-the-counter markets are so resilient, they're so big? Well, we think it's because that the dealers in those over-the-counter markets, like Goldman Sachs, can cream skim the less informed investors. I'm going to go into a little bit more detail in this slide. So imagine a world where there's only NASDAQ. So you can only trade things on an exchange. Okay. So on this exchange would be all sorts of traders. So in this case, there's hedge funds like Two Sigma. So there's guys like Two Sigma who are doing a lot of research, who really knows which direction that the price is going to move, and they're only trading to make a profit. So if you trade with people like Two Sigma, you're going to lose money because Two Sigma is only trading because they're going to be making a trading profit. And of course, if they're making a profit, then you're making a loss. So there's people like Two Sigma who knows what's going to happen and are going to be, we call them toxic. They're very, very informed, and whenever you trade with them, you're going to be adversely selected and you're going to lose some money. Now, by contrast, you're going to have guys like AIG, which is an insurance company. And an insurance company, most of the time, they're just trading not because they have cool information and they can make profit out of them, but they're just trading because they need to hedge their risk. Someone recently died and they have to pay it back, and so on and so forth. So they're trading not because of they have some amazing information that they can make a profit out of, but instead they're just trading for hedging reasons, for risk management. So these guys are the guys that everyone wants to trade with, like these insurance companies, AIG. So when there's only NASDAQ, then people like Two Sigma and people like AIG are all mixed together, and they sort of get an okay price. So AIG, everyone will tend to want to give AIG really good prices. Everyone will want to give Two Sigma really bad prices because Two Sigma knows something that you don't, whereas AIG doesn't. But then because at NASDAQ, everyone's mixed together, they're going to get some medium price. Not that good, not that bad. Now, what's going to happen when you introduce an over-the-counter market like Goldman Sachs? Well, what Goldman Sachs can do is Goldman Sachs is not a centralized market. They can just give different prices to different people. They can price discriminate, in other words. So what they can say is that to AIG specifically, Goldman Sachs can say, well, AIG, I know that you don't have any special information. So if I trade with you, I don't expect to lose too much money. So I can give AIG a really good price. But then I turn around to Two Sigma. Well, Two Sigma is going to have a lot of information. So whenever I trade with Two Sigma, I'm going to lose a lot of money. So I'm going to charge really bad prices to Two Sigma. So by giving a lower and better price to AIG compared to Two Sigma, Goldman Sachs can basically cream skim people like AIG into the over-the-counter market. Whereas people like Two Sigma, people who are very informed, they end up just being stuck at NASDAQ, at the exchange, because if they want to go to Goldman Sachs, they're going to give them a very, very bad price. So this is why over-the-counter markets, despite being opaque and so on, can have so much market share, because all those who are not very informed, who are just trading for random risk management reasons, they'll be cream skimmed into the over-the-counter market, and only the relatively informed, the highly average selected people end up on the exchange. So this is the basic intuition we're going to build our theory out of, and we're going to use this theory to answer whether it is true that over-the-counter markets, should these over-the-counter markets be restricted so that we can push more trades onto exchanges. And as you might expect, the dealers, the people who are intermediaries, like Goldman Sachs, these are intermediaries in the over-the-counter market, they tend to argue against any regulation of the over-the-counter market. They say that, look, over-the-counter markets have very high market share, they have lots of volume, and their trading costs are good compared to the exchanges. And so, of course, the over-the-counter markets are great. Okay. Now, what we're going to find in our model is that actually restricting the OTC market can improve the traders' welfare if most traders are uninformed. When most traders are more like AIG, they're just trading for risk management reasons, then in fact, restricting the OTC trading, even closing the over-the-counter market and forcing everything to be on exchange can actually improve welfare. And what we're going to also realize is that the things like trade volumes, market share, and the bid-ask spread, or the trading costs, cannot guide policy. These things do not say anything about whether or not restricting OTC market would improve welfare or not. So dealers citing these market shares and volumes and trading costs to argue against regulation, we're going to say fundamentally this is incorrect. Like these measures cannot tell you much about whether or not OTC markets should be closed or remain open. And last, we're going to propose a Pigouvian tax, a form of a tax that can help improve welfare. Okay, that's going to be very easy to implement by policymakers. Okay, so I'm going to go through the model and then the intuition behind the results towards the end of the talk. Okay, so what's the model that we have? We're going to have quite a simple stylized model of the different markets that individual investors can trade at. So in our model, there's going to be an over-the-counter market that has a dealer. And there's going to be an exchange that's going to have a market maker. And then there's going to be a bunch of traders who can choose to trade in the over-the-counter market with the dealer or on the exchange with the market maker. Okay. Now, all of them are going to be trading some asset, some stock or bond or whatever, that's going to have some uncertain payoff. So this asset can in the future end up being very valuable, or it could end up being very not valuable. Okay. And the choices that each trader has is that each trader can either buy one unit of this asset, or they can sell one unit of the asset, or they can just decide not to trade and just stay out of the market. Okay. Now here, the key friction in the model will be adverse selection. So some of these investors, or some of these traders, so I'm going to use traders and investors interchangeably. So some of these investors will actually know what the true asset value is. So most people will not know what the true asset value is, whether this asset is very valuable or very not, or not very. But some of the investors will be informed about, will have some information about whether this asset is valuable or not. And this is going to cause all these frictions, okay? Because if you trade with an investor that knows something about the asset value, then you're going to lose money, okay? So what do these investors look like? Well, there'll be two types of investors or traders. There's going to be some who are informed. So these are the people who receive some signal about the true asset value, and there's going to be mu of them. So this mu is the number or the population of informed traders in this market. And then the rest are just going to be uninformed. They don't know anything about what the asset value is going to be, and there's going to be a unit mass of them. So there's going to be, one and like a single some number of uninformed traders. Okay. So as the mu goes higher, there's going to be more and more informed people in the market. Okay. Now each informed trader is going to receive some signal about the asset value. And this asset value and this signal is going to be informative in that the signal is more likely to be right than wrong. So these guys on average know something about the asset value. Now the uninformed traders, they don't trade, like they receive no information about V, so they're not trading for profit, but instead they're just trading for some hedging benefits. So for some risk management reasons, they're trading. For instance, they just need some cash, so they're going to sell, or they want to diversify their portfolio, so they're going to buy. Okay, and each of these uninformed traders are going to have different hedging benefits, which is going to be denoted by BI, which is going to be distributed with some general distribution. So they're just going to have different types of hedging benefits, or they're all going to have different values of the amount of benefit they're going to get. And how the uninformed trader is going to work is that each uninformed trader is going to be a buyer or seller with equal probability. So some of them need to buy, some of them need to sell. And if a uninformed trader who happens to be a buyer ends up buying, so they don't leave the market, but they actually buy someplace, then they're going to receive their hedging benefit. And if an uninformed trader is a seller and they end up selling, then they're going to receive their hedging benefit. Okay. Whereas the informed traders, they're not going to have any hedging benefits, and they're just going to trade to make a profit on the basis of the signal that they get. Okay. So now we're going to take a step where it's going to be a little bit more complex in this model. So we say that a bunch of these traders informed, a bunch of these traders uninformed, and of course a trader knows whether they're informed or not. Okay, but this information, whether someone is informed or not informed, this is a private information of the trader themselves. So nobody else knows whether this particular trader is at this moment actually informed or they're uninformed. Okay. Instead, what the world is going to know is that each trader is going to have some kind of a label. Okay, I'm going to discuss in a second what a label is, but you can imagine something like the name of your company or the type of company you are. Okay, so specifically, some of these traders are going to be likely informed, are going to have a label that says, look, these guys are likely to be informed. So you can view these guys as something like hedge funds. You know, hedge funds are not always informed, but they're usually informed. So so when you see a hedge fund, well, that's like a label that tells you, oh, this person is likely to be informed. Okay. And the rest are likely uninformed. So these are sort of like insurance companies, like AIG. So if you see a insurance company, you know that they're probably trading for hedging benefits as opposed to being informed and they're trading to make a profit. Okay. So the assumption that we're going to have is that the traders who are labeled as likely informed, sort of like hedge funds, they're going to have a higher probability of actually being informed than people who are labeled as likely uninformed, which are people who are like insurance companies and so on. Okay, and we have some values there, but we don't talk about too much. Okay, so now let's and so these are the traders. Now, what's going to happen in terms of the prices? So the prices are going to be set differently in the over-the-counter market versus the exchange. So when you go to the over-the-counter market, the dealer in the over-the-counter market is going to set different prices, a bid and an ask, so some price to buy or sell that differs for each label. So they're going to charge different prices for whether someone is likely to be informed or whether someone is going to be likely to be uninformed. Whereas in an exchange, the market maker just sets a single set of prices for everybody. Everybody that goes to the exchange gets these prices. And we're to assume that all the prices are set competitively, so the dealer and the market maker will get zero profit in expectation. And the tiebreaker will be, and if a trader is indifferent between going to the over-the-counter market or an exchange, they're just going to choose the exchange. So we just have this tie-breaking rule for simplicity. Okay. So what's going to happen? What's happening in this game overall? So we're going to have that initially the traders. First, the traders' types, whether they're truly informed or uninformed, and their labels, where they're labeled as likely informed or whether they're likely uninformed, this is drawn. And then the informed traders, the actually truly informed traders, are going to receive some signals about the asset value. And then the market maker is going to post a bid and ask, post some prices for everybody. And the dealer is going to post prices that are specific to those who are likely informed versus those who are likely to be uninformed. And then each trader, they see the prices that are available in the exchange and that is available for them on the, depending on their label on the over-the-counter market. And they're going to either buy a unit, sell a unit, or they're going to exit. And then finally, the true asset value is going to be revealed, and everyone who has bought an asset is going to receive V anyone who sold an asset is going to lose V. Okay? And we're going to look for a subgame perfect equilibrium. Okay. So how do we solve for equilibrium prices here? So here, the prices can be represented by a spread. So the spread is sort of like the penalty that you pay to be able to trade. Okay, so how it's going to be set is that in each market, either the dealer or the market maker is going to set prices, set the spread such that the following equation holds. Okay, so this is what it looks like. So on the left-hand side is the profit that the dealer or the market maker expects from each uninformed trader that comes. So each uninformed trader knows nothing about the asset value. So whatever spread, whatever penalty you charge them is going to be in expectation the profit that you make. So what is this profit? Well, first it's the spread, is the actual penalty that you charge, times, well, some of these uninformed traders are not going to participate. If the price that they get is too bad, then they're not going to participate. So actually what happens is only 1 minus f of s proportion of these uninformed traders, they end up participating. So in expectation, you receive this, from each uninformed trader, you're going to make some profit of s multiplied by 1 minus f of s, which represents the probability that this uninformed trader is actually going to trade with you given the spread that you're charging. Okay. But then, so this is from the uninformed traders. But then whenever you trade with an informed trader, because informed traders know more about the asset value than you do as a dealer, you're going to lose some money. And the amount that you're going to lose is going to be, 2 alpha minus 1. So this is the expected amount that you're going to lose to an informed trader, because informed traders don't have perfect information. But then the larger the spread that you charge, some of this loss can be clawed back. So, okay, every time you trade with the informed guy, you're going to lose money. But as you charge a higher spread, you get to claw back some of that loss. Okay. And then, different markets are going to have this beta here is the ratio of the informed to uninformed trader. So this just makes up for, so this is the amount of money that you gain from each uninformed trader. This is the amount of money that you lose to each informed trader. And this is the weight on the informed traders as opposed to the uninformed traders. Okay. So when beta is higher, then there's more informed traders in the market. Okay. So this solves for the spread. This is a zero profit condition that solves for the spread. So now what's going to happen in equilibrium is that, if you think about these betas, if somebody is likely to be informed, so in a market that is full of people who are likely to be informed, this beta will be really high, and the spread will have to be higher to make up for all the informed traders. On the other hand, if most people in the market are likely to be uninformed, or they're unlikely to be informed, then this beta will be low, and this S, the spread that you have to charge, is going to be lower as well. Okay, so in equilibrium, what happens is that those who are likely to be uninformed, like insurance companies, they end up going to the over-the-counter market, because in the over-the-counter market, they can just charge this lower spread just for those who are likely to be uninformed. Whereas those like hedge funds who are likely to be informed, they end up stuck on the exchange because, if these likely informed guys were to go to the over-the-counter market, the dealer is going to know that they're likely informed, going to charge them a very bad price, and so they're going to just end up staying in the exchange. So we get this perfect separation where those who are likely uninformed stay at the over-the-counter market and they receive a low spread, which is going to be SO, and the likely informed guys, they go to the exchange and they pay a higher spread. Okay, and we're going to consider 3 different cases. So we already talked about the exchange spread, which is going to be high. There's the over-the-counter spread, which is going to be low. But then we're also going to consider the case where there is no over-the-counter market at all. If there's no over-the-counter market at all, then everyone is stuck in the exchange, and then you're going to get some medium. You're going to get some medium level of spread. Okay, so this is what happens. Okay, so now. So now to get an intuition for a result, specifically to get an intuition for why volume does not tell us anything about whether or not the over-the-counter market should be restricted, and to just get a sense of how welfare works in this market, I'm going to start with one example, one extreme example. So let's suppose that all the informed traders are labeled as likely informed. So if you're truly informed, then you're labeled as likely informed. Okay. So what this means is that these labels are very good. Okay. So since all the informed traders are likely informed, they're going to go to trade on the exchange. Okay. And we're going to penalize our experiment. Our counterfactual would be to try to penalize the over-the-counter market. We're going to try to make the over-the-counter market worse. We're going to try to restrict the over-the-counter market in the following way. We're going to lower this label accuracy theta as slightly. But this is a technical thing. The main thing you have to take away is that what we're going to do is we're going to start from all the informed traders being on the exchange, and then we're going to move some of these informed traders into the over-the-counter market. And then what happens? So we're basically, penalizing the over-the-counter market by, moving some of these informed guys into the over-the-counter market. Okay. Then what's going to happen is that the over-the-counter market spread is going to become worse. It's going to become higher. The price is going to go up because now there's more informed guys. There's more adverse selection. But at the same time, because now you're moving some of these informed guys away from the exchange, the spread on the exchange is going to improve. So they're going to get better prices on the exchange and worse prices in the over-the-counter market. Okay, so this is the experiment that we're doing. Now, the result would be that some traders, some of these uninformed traders in the over-the-counter market are going to exit because the prices in the over-the-counter market becomes worse. So some people decide that, okay, it's not worth me trading at all, so I'm not going to trade anymore. Whereas now that the exchange prices are becoming better, some traders in the exchange are now going to enter. Previously, they were not trading because prices were so bad. But then when the prices on the exchange become a little bit better, then, okay, some people start trading on the exchange who otherwise would have just not traded. Okay. So what is the impact of this in terms of welfare for traders? Well, the impact of this for welfare, you can sort of view it in the following way. I'm going to just skip this slide. So for you to actually look at the welfare, it's useful to make a following picture. So on the x-axis is the bid-ask spread in each market, and the y-axis is the hedging benefit of the marginal trader that ends up participating in that market. Okay. So initially, because all the informed traders, so we said in this example, all the informed traders are on the exchange initially. And so the spread in the over-the-counter market is going to be super low. It's going to be zero. There's no spread in the exchange, and they don't have to charge anything because there's no informed traders there. Okay. In the over-the-counter market. Whereas in the exchange, the spread is going to be super high because all the informed traders are in that is on the exchange. Okay. Now, what we're going to do is we're going to penalize the over-the-counter market by moving some of these informed guys into the OTC market, which is like this. So you can sort of see, so you have this super high exchange spread, and if you look at the marginal guy, the marginal trader that participates in the exchange market, well, their hedging benefit must be equal to SE as well. So basically, anyone with a hedging benefit below SE is not going to participate because this spread SE is too high, and anyone with a hedging benefit above SE is going to participate because yes, the spread is super high, but their own hedging benefit is even higher. Okay, so this is the marginal guy SE. Now, what happens when we penalize the OTC market? Well, when we penalize the OTC market, then the spread on the OTC market goes up, which means that some people who were trading before are no longer trading, and this little shaded area there is the amount of welfare loss. Okay, so the spread goes up a little bit. So some people stop trading, and those people who stop trading are going to be, we're going to lose the hedging benefits that the gains from trade that they otherwise would have had. Okay. Now on the and it's only this small space here, because the people who are going to leave are going to be the people with hedging benefit that's below the spread, right? So the SO increases a little bit, and only the people who are whose hedging benefits are between this initial OTC spread and the new still very low OTC spread, only those people are going to be the ones who are exiting. Everyone else still has enough hedging benefits to still trade at the OTC market. On the other hand, on the exchange, well, what's going to happen is that because some informed guys now move to the OTC market, the spread in the exchange is not going to decrease, which means that this shaded area, all of these extra people with a hedging benefit between the old SE and the new SE, that's a little bit lower, all these people are going to start participating in the exchange, and these guys are going to have the hedging benefits, the gains from trade, that's equal to this shaded area here. And the first thing that you notice is that the shaded area in the exchange, this the gain in welfare on the exchange is much larger than the loss in welfare in the over-the-counter market. So the reason why this happens is that yes, some people exit in the over-the-counter market because now over-the-counter market prices are higher, but because the prices in over-the-counter market was so low to begin with, that the people who are being forced out of the over-the-counter market are those with very little hedging benefit. These are the people who barely have to trade, but they were trading before just because the prices were so low. And if the prices just increase even a little bit, then they leave. Okay. On the other hand, on the exchange, well, on the exchange, there's a lot of people who are really desperate to trade, but because prices on the exchange were so bad that they were not trading. But then now the prices drop a little bit, and now some of these people with big gains from trade are enter and they start to trade. And so individually, the people who enter in the exchange market have much bigger hedging benefits than the people who exit in the over-the-counter market. Okay. In other words, this is where the word chip substitution comes from. The people who enter in the exchange substitute for the really cheap exiters in the OTC market, and because of that, you can actually get, there could be a lot more people who are forced out of the over-the-counter market compared to those who enter in the exchange, and yet because individually people who enter in the exchange have so much bigger gains from trade, overall welfare can still improve. Okay, so this is the main mechanism. This is the main intuition of the paper. Okay, and this means that look, things like volume and market share just doesn't matter because people in the exchange have a lot higher gains from trade. So even if you end up only causing few more people in the exchange to trade, but lose a whole bunch of people in the over-the-counter market, still overall the welfare can be higher because each person who entered in the exchange had a lot larger gains from trade individually. Okay. So now let me just go towards some couple big kickers and then wrap up. So one of the key things that we find, though, is that although trade volumes and market shares are not very useful for us to know whether or not closing the OTC market or restricting OTC trading can increase welfare, what we find is that adverse selection risk, whether or not there's a lot of informed traders or a few informed traders, this tells us a lot about whether or not the OTC market should be open or closed. Okay. Specifically, let's consider the case where we're just closing the OTC market. So this is these two are very similar pictures as before, except on the left-hand side is a case where there's very few informed traders overall in the whole economy. So these are assets where there isn't too many informed traders that are participating. And on the right-hand side is a case where there's many informed traders. So these are assets where there's lots of informed trading. So you can imagine on the left-hand side, it's like corporate bonds, which is not traded by very many informed traders, whereas on the right-hand side is something like stocks, which is traded by a lot of hedge funds and so on. Okay, so what's going to happen is well, what happens when you close the OTC market? Well, what happens when you close the OTC market is, look, let's focus on the left-hand side. Well, initially, before you close the OTC market, there's a high spread in the exchange, and then there's a low spread in the over-the-counter market. Now, if you close the OTC market, everyone's going to be paying not the high spread, not the low spread, but the medium spread, the no over-the-counter spread. Okay, so the result is that, well, this space here, this represents the gain in welfare, the gross gain in welfare when you close the OTC market, and this dotted space at the left, this is the loss in welfare when you close the OTC market. And what you'll see is that this gross gain is much larger in this case where there's very few informed traders. Gross gain is much larger than gross loss when there's very few informed traders, and that is simply because well, when there's very few informed traders, then all the spreads are sort of stuck on this left-hand side. All the spreads are all low, so there isn't much scope. For the OTC market to give people better prices and have more people enter, and so because of that, when there's very few informed traders, generally this gross gain in welfare from closing the OTC market will be much larger than any gross loss in welfare as the OTC market closes. Okay. Now, on the other hand, if you look at the right-hand side, when there's a lot of informed traders, then all the spreads are super high. Which means that the exchange spread is not much higher than the spread that everyone will get when there is no OTC market. Whereas the OTC market spread can be much lower than the spread that everyone will get if there were no OTC market. So in that case, instead, this area of gross loss is much bigger than any gross gain in welfare. And so when there's many informed traders, then actually closing the OTC market is harmful to overall welfare. Okay. So this is so one of the punchlines of the paper, and the key messages is that volume and market share does not tell you very much about whether or not you should close the OTC market, whether you should force OTC trades to be on exchanges. But then if you know the number of informed traders that are active in the market, then we can tell you. When there's not too many informed traders, then you want to close the OTC market. So for things like corporate bonds, you probably want to close the OTC market. Whereas for assets where there's lots of informed traders, like in equities, like in stocks, then you want to keep the OTC markets as is. Okay. And well, because I'm running out of time, I'm not going to talk too much about the tax, but there's a very simple way that you can implement the tax, which allows you to really maximize the amount of participation in the market, and we give some details about that in the paper. Okay, so let me conclude. So what do we do in this paper? So we first show that we first take a stand and we say that, well, the OTC markets can thrive despite all the regulatory pressure they face, because price discrimination by dealers. Dealers can cream skim those who are less likely to be informed. Okay. And our question is, well, should OTC markets be closed or should they be limited? And we say that, well, only if that asset has very little informed trading. For assets that have little informed trading, then the OTC market should be closed. For others, it should be kept open. And we explain this using a new mechanism called chip substitution, where individual, as you restrict the OTC market, the new entrants in the exchange are individually going to have higher gains from trade, higher hedging benefits than those who are pushed out from the over-the-counter market. And this mechanism means that things like trade volume and bid-ask spreads are not very useful for useful guides for policy. Okay. And then we also have a tax that we design a tax that can be used to improve them. Okay. So that's it. And I look forward to some questions.
So thank you, Tomy, because it's really interesting research, and the result also is really interesting. And nowadays investment is really important for the people because they really wonder how is the system is going in the investment part. So this result shows the exactly different part. And thank you for the sharing to us. So we have some fifth question just to understand more clear the system, how is the going honestly. So I will look to our questions. So okay. So in the first question is about you exactly focus the system of the OTC, and we asked the why can OTC restrictions raise welfare under low adverse selection, and how does this extend existing theory?
Okay, so yeah, so thanks a lot for that question. So this is basically in this slide here. So the reason why restricting OTC trading can improve welfare when the when adverse selection is low is basically because of this. So we can basically show that when the spreads are all clustered really low, then the amount of price improvement that the OTC market can give to the likely uninformed guys like the insurance companies is very limited, because the spread, even if the OTC market didn't exist, the spread will be low, and so the discount that the OTC market can give people is very limited. And for this reason, closing the OTC market doesn't have too much of a loss in terms of welfare. But then by moving a lot of uninformed people onto the exchange and by improving the exchange price, it can still have a big improvement in welfare. Okay, and this result happens to be, I think, is actually our main result, and it happens to be extremely robust to all sorts of. It's very general, and our contribution is that basically previously none of the existing papers have this prediction. So ours is the first one to make this prediction, and it happens to be very general. It holds under very general conditions. So so I think this is actually the main reason why the paper got published. Okay.
Yeah, it's really good, because always we think the volume is important for the investment part, but that's part we understand honestly is just important. If the investment wants to earn money, the volume will be not too necessary, not big deal for this part. So yeah, thank you so much for these questions, and let's look at the questions. Right. Sorry, just wait a minute. Okay, and so we know also the market has some noisy and irrational behavior, and how does noisy or in carry trader labeling undermine market segmentation between OTC and exchange markets?
Oh, so that's a great question. So in fact, in our paper, noisy or irrational behavior would be in some sense good for markets. So for those who are trading irrationally or noisily, they're going to lose money. But the people who trade for irrational reasons, well, they're not adversely selecting the dealers or the market maker. So if you have all these additional noisy noise traders or irrational traders, it will actually improve spreads on both markets, because now that the dealers know that there's going to be a bunch of traders who are just trading for random reasons. Okay, so it's going to improve market, and it's not specific to our model. It's also the case for Gloston and Milgram. It's for Kyle 1985. All the classic models would predict the same, where if you have more noise traders, then the prices everywhere will be better. So that's the first question. Now, actually, the specific question is about market segmentation. Now, for the market segmentation, it is unclear. So here you'll have to specify, do these noisy traders, do they go to the exchange? Do they go to the OTC market? What kind of label do they have? Depending on those other assumptions, you could get all sorts of results for whether it's going to make the OTC market bigger or smaller and so on. So that one needs a little bit more clarification.
Yeah, it's really good point, honestly, because also we are thinking how happened if we are talking about noisy or irrational part in this part, so it will be more clear. Thank you so much. So, and I know we had the time limit, but I also want to focus Pegunian tax. So we have some question about it because I know you just want to talk about it, but we have the time limit. So the question is, how is the optimal Pegunian tax derived, and why is the weighted split ratio central to its design?
Oh, okay. So, so let me talk very, perhaps briefly about it. So, so the key part about okay, so this is a good question. So what is this Pigouvian tax? So here there's a bunch of equations, but I'm not going to talk too much about them.
Yep.
So the key takeaway from this equation, for instance, is just that, well, if you have some tax, what do we want to do with the tax? Well, in this market, what is happening is there's uninformed traders. And when uninformed traders choose to go to the over-the-counter market and get the discount, get good prices in the over-the-counter market, they're not internalized. The externality that they're imposing is that by doing that, they're making the prices for everyone else on the exchange worse. So you can imagine everyone's originally in the exchange, and then someone who's very uninformed, they move to the over-the-counter market, and by them moving, it makes the prices in the exchange worse. So this is the externality. So you can correct this externality by charging a tax on OTC trades, and you use the money that you raise by taxing OTC trades to subsidize trades in the exchange, and this can actually improve welfare. And what we have is this weighted spread ratio, which is computed. It's something that can be easily computed, and this weighted spread ratio just tells you whether you should impose a tax on the OTC trades, and whether the tax should be higher or lower. So that's it. So
yeah. I see, because I think WSR is the central of this design. So for this tax, so that's okay. So also we have one, or I think we have two questions more. So just a minute. All right. Oh yeah, here we go. So how does banning dealer price discrimination affect spread, and why is the SE to SO relationship policy relevant?
So if you ban dealer price discrimination, so that's basically this case here, this SN case, where there's no OTC market. So if you ban price discrimination, then what you're going to get is that the spreads on the exchange are going to become better, whereas those who used to go to the over-the-counter market, where they're going to get worse spreads than what they used to get. So you're going to get some middle spread for everyone. So
okay.
Yeah. So this is what happens. And as for why is SE minus SO relationship policy relevant, I mean, that's just policy relevant because it's the changes in these spreads that determine, whether determine the changes in welfare in the two markets. So that's why, specifically, the spreads are the ones that determine, who participates and who doesn't participate, and this is what determines welfare in this model.
Okay, it's just about middle part. So middle spread. So it's clear about it. And one more question we have is kind of the discussion question. Honestly, I know this paper doesn't focus any causal system or any macroeconomics part, but we have some question about it. We are talking about winners, losers, and so the question will be kind about it. So in causal system terms, who are winners, losers under chip substitution with low informant risk, and what are the distributional effects? So I think should be important to understand the clear, because we always talk about the winners, losers. So also in this part, the paper is talking about known and unknown investments. So I think should be more clear about that part.
Yes. So I don't understand the part of this question, but Kuznets style terms. But okay. So one thing is we can clarify, or I can just answer about winners or losers. Okay. So about the winners and losers. So we should talk about, well, when you say winners and losers, we have to talk about policy. So here, let's see, let's talk about the winners and losers when you decide to, ban price discrimination, or you basically ban over-the-counter trading. Then the winners are going to be those who people think might be informed, but are in fact not. So, for instance, you can imagine a hedge fund or just any fund that has a reputation as, oh, they're usually informed. But sometimes these funds, they desperately need to trade. And sometimes when they desperately need to trade, perhaps they'll go bankrupt if they don't trade right now. And they're not trading because of information, but they just need money or something like that. So funds like them, people who might be often informed, but might be facing, very, very severe needs to trade, they're going to benefit when you restrict OTC trading. Whereas, those who are trading for, very little gains, people who just are trading because they can, marginally increase diversification and so on, those are the people who are going to lose out. So it's the people who benefit little, they're the ones who are going to lose out, and people who could potentially benefit a lot, they're the ones who would tend to benefit. Okay.
So I just have one more question, Tommy. When we talk about causes, we are talking about inequality part. So we are talking about winners, losers. So generally, in common information, if some investment doesn't know information in the investment part, they cannot earn money. They cannot investment better than unknown people. So it's the basic part. So just my question, I know you didn't look this part. I just wonder your idea, honestly. This research, how affects the inequality? What do you think about it?
Okay, so inequality here. This would generally suggest, I think an intuition of this paper would be that if it is the case that the informed people would tend to be richer, which may or may not be the case, it's not that clear. Because, for instance, some uninformed people could be those who, have a lot of pension funds and so on, and a lot of money in the pension fund, and the pension funds are just trading. Okay. But if it's the case that informed traders are the ones who are richer, then I would think that this would mean that restricting OTC markets would increase inequality, because basically it will make the prices better on average for those who are informed, whereas it will make prices worse on average for people who are uninformed. But now it's not totally clear, because some people who are uninformed will now be able to participate and trade, whereas before the prices were too bad for them. But probably overall, it's going to increase inequality if the informed people are the wealthier people.
That's really good. So I think all question is done, and I'm so happy for discussing this article with you, and it's really interesting. So I would like to say thank you again. And so just I want to be a little bit more information for reminder who are you and which article we discussed. And so today on the first day of the Congress, and we discussed the article regulation over the counter market with Associate Professor Tomy Lee, University from Central European University. And I would like to say really thank you, because I'm so happy for discussing, and thank you for your participation, and thank you for contribution. And if you want to say something, it's your turn.
Oh no, thank you for being here, and thank you for inviting me. And it was good to present this paper again.
Yeah, thank you so much. And so this is end of our session, and see you in the next session, guys. And thank you joined us for everything. See you.
Thank you. See you. Bye.